Hello and welcome to another edition of Nucleus Investment Insights. We're opening with a bit of a rally last night on the US markets as interest rates cuts seem to be getting closer over there. In the meantime, there's still talk in Australia about whether there's still a rate rise or two still to go in Australia. So we thought we'd address that issue. Is Australia going to be raising interest rates just as the rest of the world all starts to be cutting? So bringing in Dave to help us out, just a quick reminder for everyone that nothing you hear today is personal advice. It's all general. And if you do want some personal advice, give us a call, book in a call, and we can run through what your options are. With all that aside, welcome aboard, Dave.
Hang on. Yes. Sorry, I think I've turned you down.
Okay. Lost you.
There we go. Yes.
Yes. Excellent. Yeah. So I thought with no further ado, we'll just sort of jump straight into it. We've got a few different things we want to run through today, starting with sort of neutral rates. What are neutral rates around the world, and then what are the what's sort of going on in each country, and then finally sort of getting back to what are the investment implications, and if last night is anything to go by, the more certainty around rate in terms of rates weakening seems to be pretty positive for the stock market.
Well, yeah, for one night anyway.
That's right. Yeah. Well, but I think it's probably more, and I should define that a bit more closely, shouldn't I? In that, if we've got relatively strong growth and growth that's not too weak and interest rates falling, then that's good for the stock market. If the growth gets too weak, then it starts to turn. Yeah, so it's good until it isn't.
Yeah.
So we start with the US, maybe, Dave?
Yeah. So we're going to do a tour of neutral interest rates, given we're about to enter an easing cycle. So this is a sort of attempt to give some guidance on how low rates might go from where we are, given where we have had tight interest rates, sufficient to deflate demand and inflation to the extent that it was inflated by demand rather than the supply shock of COVID and Ukraine. And so how far will rates fall, to cut a long story short? So we'll just have a tour around the world and see where those rates might fall, and then look at Australia and see how we'll compare. Note, I say fall in Australia as well, because I think any rate rises here are cooked now. So we'll start with the US. Cash rate there is currently at it's currently at 5.25. The Fed sees its neutral rate at 2.8%. It's risen by about 0.5% over pretty much the period of the pandemic. And so they have kind of acknowledged that, that there has been a step up in inflation potential in the US since the pandemic. I think the Fed is likely to start cutting in September, and will probably cut faster than most people think. The market has a pace of cuts for about one per quarter. I think it'd be more like one per meeting, frankly, but we'll see. So one of the key inputs into that.
And sorry, just defining the US, repeat once every 6 weeks is roughly the US.
That's right.
Times, so, yeah.
So the key input, there are a couple of key inputs that I've listed here into US rates. I think these are the major ones. Fiscal spending is obviously going to be very significant determinant, and in that respect, whether we get the Dems or the Republicans, both are going to be pretty big spenders, but owing to the structure of that spending and revenue raising, I think that the Trump administration, at least in its first year or two, would probably be more inflationary.
And it's probably worth noting, though, as well, if you get like a bit of a split House or Senate, something like that, you still the Republicans are still likely to get some of this spending through. Whereas if you end up in sort of a split House Senate thing, it might turn into the Dems wanted to go and spend money, but Republicans who might have voted for the spending if it's Trump might then not vote for the spending if it's Harris.
Yeah, they're a lot more partisan on the Republican side of the aisle, so that's fair enough. Just a quick aside, I mean, our latest thoughts on the election itself is that, anyone tracking, aggregated polling for Kamala Harris will have noted that she's on an absolute tear. Is probably polling a little bit higher now than Biden was before he melted down in the first debate. Trump's still ahead by a point or two, but it's all of a sudden looking quite close. Slightly less close in the swing states in the Midwest that are going to decide the election, but still, a much closer than it was. And we just do wonder if all of the material that was thrown at Joe Biden and the sort of about his age and mental state doesn't blow back now on Trump, not just in the sense that it was thrown before at Biden, but in the sense that having a younger candidate, so much younger, intrinsically just shows up what an old fart Trump is, nearly 80 himself. And, really, that's a significant advantage for Harris. So, a lot of water under the bridge, but we're sort of wondering if Harris isn't edging her way to favoritism if she can hold together the sort of intellectual and policy matrix, especially through the debates and stuff. So still behind in the polls, still very much behind in the betting markets, but we're just starting to wonder. So fiscal is significant. The history of US elections is that there's quite a deficit of spending particularly when you shift governments, but every new presidency seems to bring a kind of gap, a bit of a wind shear for spending, which is why some of the strategists on Wall Street, in particular, I'm talking about Michael Hartnett at B of A, who's very good, are arguing that even a Trump win would actually be quite deflationary and trigger swifter rate cuts because there's just this up of spending into the election and then quite a gap afterwards that the economy can fall into.
Yeah, and in terms of timing wise, it's if you've got a 4-year term, then not spending that much money in the first year and ramping up your spending into years 2 and 3, so that the economy is really booming by your
that's part
next
of it
election.
As well. Making your tough decisions in the first year is also part of that thesis. So it's not a stupid way to think. And so it's another reason why I'm wondering if there won't be sharper cuts in the US than is currently priced. The labour market's another huge input, and as we know, the US has had this kind of post-COVID labour gap of about 5 million workers that has held wage inflation or wage growth higher than the previous cycle, although it has started to dip towards the higher levels of the last cycle. But that could bottom out again a little bit election related, especially if Republicans get in and immigration is cut, less so with the Democrats. But that labour gap and firmer wage inflation, are probably the key input into why the Fed has itself lifted its neutral rate by 0.5% from before COVID. And so that's going to play a role in keeping rates a little higher than they were previously. We think the deglobalization issue is pretty over-egged for the US, doesn't affect it that much, and probably positively at the margin. You have, while some argue this is a very inflationary issue, we don't really see it that way so much. Obviously, if there are tariffs, it would initially be inflationary, but the scale of shock to China would make it deflationary pretty quickly. And then you've got friendshoring and all these other factors where production and cheap production just shifts to other cheap jurisdictions rather than the US, especially.
And the other thing is the US is having a reasonably sized capex boom at the moment as well.
It is, yes. Although that's another issue for growth next year because leading indicators on that capex are falling off. So, I mean, there's been the factory boom and now the data center boom out of AI. They could come off together. That's a downside risk rather than a certainty. And then AI, of course, the swiftness or slowness of its rollout into a genuine business case for widespread implementation in corporations, and to the point where it starts to actually dent labour demand, is going to be an issue for this easing cycle at some point, likely. Well, certainly the business cycle coming out of this easing cycle. How quickly that happens, is obviously impacting markets at the moment, figuring out whether it's slow, medium, or fast. But basically, if it does come, or when it does come, we think it will be deflationary. And so again, potential there for the US neutral rate of interest to certainly be reached over a period of time in this easing cycle, and even to actually deflate a little from where it was, or from where it is today. That's a key point to make just in the framework of this discussion. Neutral rates of interest, or R star as they like to call them, are not fixed. They can be very different cycle to cycle, and so as the issues that determine the business cycle come to bear, that number can shift around. But my own view is it's more likely to fall than rise in the coming cycle. So in short, the US has a fair bit of headroom to cut rates before it even reaches neutral, which of course is the point at which kind of inputs, outputs, and inflation are all kind of in balance, and it's nirvana for the central bank.
Right, Europe.
So Europe has a much lower natural or neutral rate of interest, at least according to the ECB and various other people that surround it. It's not as clear where it is, but it's kind of somewhere between 0 and 1 in Europe, according to the pundits. Currently at 4.2, so even more headroom to cut than the US, and probably more reason to, quite frankly. Fiscal is less significant there, obviously, just because of the constraints of the Maastricht Treaty and the difficulty in integrating national budgets with Brussels. That said, the Ukraine war spending, is a bit of an unknown on that front, especially if you've got a Trump administration. European fiscal could be much stronger versus Democrats.
And the reason for that is the expectation that Trump would greatly reduce the amount of support and possibly withdraw all support for Ukraine, and then Europe would then step up and actually step in, start spending.
But at least in sort of base case terms, fiscal is less significant in the US as an interest rate determinant than in Europe than the US. But there are offsets to that. The key one, still is energy prices after the Ukraine war. Still quite high in Europe, about the same as Australia, a little bit lower than Australia, but roughly the same prices. We're talking, gas prices 12 to 15, more like $15 to $20 Australian for gas, and kind of 100 to 150 megawatt hour for electricity. So, I mean, they've been in deflationary because they've come off so much, but there's a possibility that those prices could stay high. That said, I think the key input is gas, and there are, still every year henceforth, but particularly from around 2028, there's just a lot of new gas in the seaborne market from Qatar and especially the US that would see these energy prices continue to fall in Europe. So they probably, an undershooting risk rather than overshooting, but you never know. Something could go wrong with Ukraine and Russia and what have you. So
yeah, and short-term spikes, they have some cold weather or particularly hot weather, and it takes out other sources of
China and deglobalization is a much bigger issue for Europe. Not particularly deglobalization, more China as an export destination. Chinese and European growth have been tied at the hip really for the last 10 to 15 years. And so as China, kind of goes down the toilet, as we expect it to continue to do, Chinese growth to just keep falling, then that at the margin is going to weigh on European growth. And so that's deflationary as well. And then we come to AI for Europe and expect that over the longer time frame it would be material, but probably not as quickly as the US, where there is such large kind of head starts on all sorts of applications for it, including autonomous cars, for instance. But so again, we would expect to see some pretty decent cuts in Europe in the next kind of 18 months, and then potentially to keep falling when the US stops falling, because structurally it's just a weaker economy and probably therefore more deflationary.
More aging.
and more aging as well, and less dynamic, of course, and et cetera, et cetera. So that brings us to our third big economy, and this is the real deflationary epicenter, this one in China. So the PBOC, we're kind of roughly guessing that the PBOC sees a neutral interest rate around 3.5%. It's currently at 3.35. However, in our view, and we think you can see this in its losing battle with the bond market, the PBOC is losing credibility on its attempts to keep interest rates high. It is doing this, amid, relentless deflation, not just disinflation, but outright deflation, as the housing bust, comes a cropper. The demographic headwinds all give it a belting. And the 5 Ds, one of those should actually be demographics. But the five Ds of too much debt, deleveraging, demographics instead of deflation there. Deglobalization obviously is very difficult. And then dictator, where, Beijing, for ideological purposes, has decided that it will endure deflation rather than stimulate domestic demand to help fill the debt deflation implosion coming out of households and the supply side from the housing crash. It simply does not like giving consumers money. It thinks it's a waste of time because you don't really get a legacy of any investment out of it. You don't get, for instance, any more factories or anything to export from. But I think even probably more importantly, the Chinese Communist Party just doesn't like to have overly powerful consumers and households, for the obvious reason that with more money comes more power. They like to keep the national income under control within the state-owned enterprises on the supply side of the economy, and so that's a kind of subset of why dictator is deflationary, or a dictatorial regime is deflationary in China. And so basically, from my point of view, China should already have zero interest rates, and probably be doing QE as well, and be letting its currency go completely, because if it doesn't do that, it's just intensifying its debt deflation.
Yeah, and one of the pettest arguments though as well for in terms of China and the just the structural differences, because Chinese consumption is so it's been pushed down so much proportion of GDP, and they're saving effectively. They end up saving more. All the borrowing's being done, or most of the borrowing's being done by SOEs and corporates and governments themselves. And so when you lower interest rates, actually you're actually biasing against your consumers even more. Like you're exacerbating the problems in some ways because currency goes down. Now they can actually consume less, and so now you're ending up in a self replicating cycle in terms of lower interest rates means less in terms of interest, lower currency, therefore the consumers are actually worse off. And
well, be that as it may, I think that's right at the margin. But once they've made the decision to let their housing and construction bubble go, then all of those become secondary questions.
Yeah, well, given the way they're playing it, I mean, really what they would be doing is doing lowering interest rates to zero and then subsidising the household sector and transferring lots of cash into the household sector to get them going.
Yeah, that's right. They need to support the deleveraging, both in terms of reducing the debt burden on households and doing fiscal transfers to the households, but they don't want to do that. And so they're actually Japan, but worse, because at least Japan did do these things before too long, whereas China seems to intent on resisting them. And this is the battle I'm talking about between the PBOC and the bond market, where it's losing, and that is it's been trying to jawbone long-term interest rates higher, and everyone just keeps bidding the wazoo out of the bonds, and interest rates keep falling, which is, the natural course of events in these circumstances. And the more they fight it, the worse it gets, because markets are bidding on the debt deflation. So that is being embedded. And so, the Chinese input into everybody over the next few years is deflationary. Their own interest rates will keep falling. The yuan is a big swing factor. If Trump got in, for instance, and they let the currency go, they may not need to drop interest rates quite so far. Excuse me, but for all intents and purposes, they appear determined to deflate themselves to death. So there's only one outcome for interest rates in those circumstances, which brings us to little China down under, and what this will mean for Australia, because it's going to mean a lot. Very different to the current environment where people are concerned about another round of rate hikes. I've never been on board with that, and I think yesterday's CPI put it to bed. You have trim mean still falling, and in addition to that, that was the June quarter. In September quarter, all of the energy rebates and stuff start flowing through into headline inflation. The RBA keeps arguing it's going to ignore it. All these rebates, but I just find that argument preposterous. The rebates will be there as long as high energy prices are, and so kind of ignoring those is kind of waiting to see if politicians will be venal. I mean, they will. So what are you waiting for? And so I think that the penny will drop on that. And so headline inflation is going to drop very sharply for the rest of the year. Trim mean more slowly, but the one will trickle into the other. And frankly, I can't see the RBA fighting headline anyway. For those reasons, that it'll become clear that the energy rebates are going nowhere fast. So the rate hike cycle's over, in my view. The RBA, I've got a chart here, the only chart in today's presentation, has really no idea about neutral interest rates. as we saw in the last cycle, where it never dropped its neutral interest rate, its perceived neutral interest rate, but beyond 3%. But we were at 0. And so, keeping the neutral interest rate at 3 for however many years we were at 0 was pretty silly. And this is the reason they were so slow to bring relief to Australia in the last cycle. Refused to fight currency wars, kept their boot on households, watched persistently thought wage inflation would take off, and completely overestimated it non-stop for about 8 years.
Yeah, but even if we didn't go to the 0 bit, like we were still at sort of 2% for ages, not being able to get inflation going.
And it was too high.
Yeah, exactly. Yeah, so clearly too high, but they're sort of sticking with 3 as being the number, and continually forecasting a rebound in wages and all these other things.
Yeah, it's all a bit crazy. And now they see it more like 3.5, right? Now, right now, it probably is 3.5. As I said, these numbers are not fixed, but you have to look at the circumstances. Is today's economy a sustainable matrix? No, it's not. It's driven by massive retail deflation. Falls in retail recession, per capita recession for 60% of the economy, which is households, and there's just enough offsets in basically rampant public spending into infrastructure and just employing too many bureaucrats and throwing money, willy-nilly at whatever. In other words, we've turned it, we just pushed tax take and government spending to like record high proportions of the economy, while everybody who votes is actually going backwards. And so none of this is sustainable, either economically, in terms of budget stresses, or politically, in terms of households getting the shits.
Just before we get to the investment part on this, I might just jump to a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so quick recap. So we've got US sort of sitting a fair bit above their neutral rate, sort of 2% or more above the neutral rate, and thoughts they're going to start the rate cutting cycle pretty soon. Europe sort of already started its rate cutting cycle, but we think they can go a lot lower than to where they are, and a lot of sort of concerns over there. China is already below its neutral rate, but we think that's neutral rate.
Well, it's perceived neutral rate. I think it's miles above its actual neutral rate.
Yeah, well, that's right. It's quite possible it's got a neutral rate of 0 for the next 20 years until it sorts out.
That's right.
Sorts the shit out. Yeah. And then back to Australia, where we're sort of not that in RBA terms, not that far above our neutral rate, but we actually think it probably is a fair bit further. And I guess keeping in mind Australia didn't raise rates, so there's sort of two parts to the Australian equation. One is we didn't raise rates as high as most of these economies, but secondly, the rate rises we have actually flow much faster through the economy. So in a, how much did you slow the economy sense? We've probably done as much as most of these other economies, but in terms of the actual nominal rates you're seeing are not the same. So the summary of where we are.
So that's good summary. So basically, I'm arguing that the current structure of the Australian economy is unsustainable, that the fiscal pump is going to be turned off, it's already basically going to plateau over the next 12 months with state investment into infrastructure topping out and federal already falling. And so that gives you zero input into growth on the investment side. They'll probably continue to spend wantonly on bureaucrats and other stuff, but it's already, you can already see how it's going to fade. But the critical change is China, I think, and we got a taste of it this week with a pretty nasty accident for iron ore and coking coal. Probably more panic than reality at this point, but it is a taste of what's to come for those major commodities, and the same for gas. And gas means thermal coal, so it adds up to sort of 60% of Australia's terms of trade is going to spend the next 3 years completely underwater. Now, there is some of this priced into the federal budget, and it's already kind of told us Canberra's already told us what it's going to do to cope with this, and that is it's just going to rerun the playbook of the 2015 crash, or the post-2012 crash, really, that ran through to 2015 of the terms of trade, I mean. And that is to just run silly levels of immigration to, crush load everybody, kill wages, and in effect to shift the adjustment of falling national income out of terms of trade crash onto households almost exclusively, which is insane policy. But, this is what we've come to.
Yeah. But the political benefits, though, the political benefits are you get to appease your donors, who are often your sort of vested interests, who all like this model because it means cheaper wages for them and more demand if you've got monopolies and things like that. And then the second thing is you get to say what a great economic manager you are because you didn't fall into recession, because
exactly right.
2% extra people every year. It's very hard to get
all the damage is per capita as usual, and the headline numbers are sort of sustained enough. So that is a sort of emerging, very deflationary environment. Australia does have a massive productivity problem. We're just too apathetic and lazy and corrupt to get productivity moving the way the US is already and will do through much of the cycle, I think, through tech investment.
And when you say corrupt, I think I'd probably point people back to some interviews we've done over the years with Cameron Murray, and it's not the corruption you see elsewhere. It's what Cameron terms as grey corruption, which is not it's not deliberately taking bribes and not there's stuff that can't really be pinned on it, but it's effectively going, well, we all went to school together, and so somebody gets some companies that already have monopolies and everything get more licenses, or they don't get competitors that they perhaps should have had, or you've got airlines that get to run anti-competitive behaviour and that keeps chasing out new entrants. You get the regulators are very close with the people they're regulating, and they sort of the idea is you get to be a regulator for a while, say the banking sector, and then you do that for 10 years, and then you come out and you get this massive big payday when you get to go work for one of the banks for some massive amount of money. And so none of it's explicit, but it's all sort of this idea that it's great. It's grey, but it's
grey. It's grey and it's rampant. So vested interest corruption, basically. Control, fraud, call it what you will. Australia is absolutely chock-a-block with it. And so we have a very weak productivity as a result. And that would typically be quite inflation, especially for wages, but in Australia it's not, because you counterbalance that with immigration for those vested interests, which is a permanent supply shock in the labour market, and so you end up with weak productivity and weak wages, which is just an absolute bobby dazzler of an outcome. But it is very deflationary even so. Now, there are offsets to that in this cycle. Immigration is not quite as deflationary as it was over the last, because two reasons really, and they're interrelated. We have a massive housing shortage and a completely mismanaged housing construction market, with labour shortages despite really high immigration for demand. And the other part of it is we've got this incredible energy disaster, especially for gas prices and electricity prices, and building materials are very energy intensive products, and so these things are kind of playing into one another to create an inflationary pulse that we didn't have in the last cycle, which I don't know, people may remember was actually driven by massive building of apartments, largely from offshore developers, especially Chinese, and all that investment's gone. And instead we have, Albo, the disaster, claiming he will build 1.2 million homes, and he's actually going to build 700,000. And so you do have an ongoing inflationary pulse there. That means that we'll probably have, an extra half point of inflation in Australia in the coming cycle.
Yeah, and this is though, I guess the big issue is this is supply constraint inflation, which is not the type of inflation that is really dealt with through interest rates.
It's not, and
so
moreover, it actually.
For people that are sort of unclear about the differences, is what a typical cycle is. People start borrowing money, they're out spending, there's all this capex going on, everything's growing really quickly, and people are doing too much in terms of that front. So you actually need to rein in demand. And so you raise interest rates, people stop borrowing as much, capex sort of falls away a little bit, you rein in demand, you go through a bit of a bad debt cycle, and then you lower interest rates and you back out and off you go again. Whereas what we saw in the pandemic was that this whole when supply chains get all blocked up and all that type of stuff is that's the one, you raise interest rates, that doesn't unclog your supply chains, and so it's about saying, well, what's the driver behind it? So the rest of the world sort of moved on into the more of a demand and supply side sort of frozen up, but what David's talking about is saying that if you're bringing in massive amounts of people, then you've still got these supply side constraints that aren't being, you can't fix by just raising interest rates. You've basically got to actually, you really got to punish it. And if you're going to do that, you really got to punish a few of the sort of sectors that aren't really involved in it. You got to go demand from average or a little bit weak to really weak in order to bring down the demand enough that it actually affects the supply side. So we spoke about it. It's been spoken about as the burnout economy. You've got one foot on the brake and you're pressing the other one on the accelerator, and so you're burning out rather than actually going anywhere.
Yeah. So, I mean, so yeah. I mean, on balance of all that stuff, I still think the Australian economy will be quite deflationary or disinflationary from here, and interest rates will fall much further than the RBA's neutral rate of interest suggests. Now, we may not need to go all the way back down to zero, but I mean, I can't. I don't know where the neutral rate of interest is in Australia, but I can tell you it's a lot lower than 3.5%. When you're in the middle of a terms of trade shock that's coming out of China, well, it seems inevitable at this point. So, might be more like 2% or even 1%, but it's going to be much lower than 3.5 in my view. So, and Australian rates are at what, 4.35, I think. So that still gives you a lot of headroom for the RBA to cut.
Yep. Quick sales message, and then we'll wrap up with some of the investment thoughts and some questions.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So a quick question, or I guess more of a comment from Wiser 3754, but I think it probably fits with what we're talking about. So he's just talking about seeing the downtown and the small business he's working for going bust after 17 years. There's certainly this issue around we are seeing rising insolvencies, still not sort of at a level you'd be particularly concerned about in Australia, but certainly the trajectory is not in the right direction. I guess any thoughts of yours, Dave, around insolvencies? How far are we away from what they actually do?
Does he say what sort of business it is?
No.
Well, I mean, the big ones that are really copping it are hospitality in terms of eating out, because household volume spending is just falling. Some broader retail and dwelling construction is getting smashed, even though demand is through the roof. They simply can't afford to build because of that supply side inflation that we've described. So, ironically, I think that cutting interest rates will probably eventually aid more deflation in housing construction than otherwise, because you'll just get some more supply at least, and that might help bring down some of the sales prices. But yeah, it's most of the demand side of the economy is in recession. Like nearly all of the activities on the supply side. So if you're exposed in infrastructure and government spending and things, so if you're exposed to that, then you're in recession and you're in pain.
Yeah. So he's just click the comment. It's spray painting, particularly kitchens and shop fronts.
Okay.
Sorry.
Yeah.
So,
okay. So
it is construction very much.
Yeah, and retail. So
that's right. Both best of both worlds. Worst of both.
Yeah, worlds. That's a real double whammy. So we feel for you. There's probably a little bit of relief with rate hikes coming, but I mean, it is problematic. A lot of those issues are actually policy based on the fiscal side. That's being really badly mismanaged, and rates can only do so much to combat it.
And the other lurking issue in property is the commercial property sector still as well.
And that's a global story. Absolutely. I mean, vacancy rates are amazing.
Yeah, but investors have been willing to keep on rolling these over. Investors to date have been willing to keep rolling it over and keep just going with lower vacancy rates and assuming that it'll eventually come good. But there's a risk that at some point they give up and you get a bit of a property crash as well.
Yeah, I mean, although that's not particularly a banking issue, it's a risk.
Yeah, and I think though, in terms of that risk, as you said, it's not particularly a banking issue insofar as if it had have happened coming out of that Silicon Valley Bank last year, it might have been more of an issue because it's front and center. Not completely surprising, but it was pretty gave a lot of, especially small banks in the US, a real wake up shock. Whereas issues that have been around for a number of years, they can be chronic and drag down performance, but they tend not to be as acute. So if you've known about this potential for property issues for, it must be 2 years now at least, banks have been doing what they can to start moving them off. And so it tends not to be as bad as when it's like a sudden, not a surprise, but, you go from boom markets to bust markets. That sort of, whereas it's been a bust for a while, it tends to be less damaging.
Yeah. So wrapping up with some market implications, I think what we're seeing already is the potential for rate cuts, at least early in the cycle, to trigger a growth scare, because once rates start falling, markets start wondering if growth is there. It's not, as Jay Parr was at pains to talk about last night, it's at this stage it looks like more of a growth normalisation than it does anything recessionary. And I'm on board with the soft landing. I think that's true. But there's soft and then there's softer. And there's a fair bit of scope in there. If you end up with, some US growth with a 1 in front of it, that's not exactly all that soft if you're down around 1.5 or 1.6 or 7, or with falling inflation to boot. And so you've ended up with nominal growth approaching 3% and corporate profits revenue growth of 3%, and it becomes very difficult to generate the kind of profit growth that we need for the high valued and concentrated stock market that we have. And so it's not at all impossible for us to have a softer the softer end of soft, triggering a growth scare for the stock market. Now, that's, I think, the top-down cause of today's increasing volatility, especially in the US. And then there's bottom-up issues as well in terms of AI profitability and other things that are inputting into it. The US election, of course, as well. So I think in the early days of this easing cycle, we are going to see some growth scare, especially if we end up with a Trump administration and a real accident in China.
And you're talking about growth scares that affects Australia very much so, aren't you? Because I wanted to say on the company earnings side, earnings this quarter have been, look, they're not great. They're not. It's not like they're fantastic, but in terms of every other quarter for the last 2 years, they've sort of come in like 6 months out with an expectation of sort of 5 to 10% growth, and by the time it's all said and done, it's been negative growth. Whereas this time we've come in with the expectation of 5 to 10%, and it's coming in around a 5. Like it's going to. Yeah, at the lower end of it, but
I'm talking about
way better than what we've seen in the last few quarters.
Yeah, no, I accept that. But I'm talking about markets discounting 6 to 12 months out.
Yes,
and it includes the US, Europe, but especially China. Like anything China linked is in for it, especially if we get the Trump administration. So. Based on everything we've got here, probably Australian interest rates fall a little slower than elsewhere initially over the next 12 months. Maybe we get our first cut before the end of the year, and then maybe 1.25 after that. Just as they're higher for longer, as they worry that that some of those more entrenched inflationary factors are taking time to ebb. But I think, again, around this China issue, that the terms of trade shock just keeps building right through 2025, and it just forces the RBA's hand more and more as fiscal comes off more and more, and national income is hit harder and harder, and nominal growth too. And that means a serious blow to profits for Australia as well, because profits are driven by nominal growth. So then on top of that, we've got the immigration response in the middle of an income shock, and that's bad for wages. It means higher taxes as well for households as the budget comes under pressure, and so demand's pretty weak. And again, more RBA easing. And so, where does that land? Because you've got the Fed kind of cutting earlier and harder, and the RBA later. You probably got some upside in the currency at some point, but it's struggled to sort of stick already because the China issue just keeps coming back and getting worse and worse. And so I'm not sure that I think my current call on the currency is just sell the rallies. When you get a rally, sell into it, and the trend is likely lower. Then you get into we have this amazing bank bubble going in Australia where CBA is transformed into the Magnificent Eight, trading on absolutely spectacular forward multiples and without any earnings growth that anyone can see, which is just all pretty stupid. And I would expect accelerating RBA rate cuts to really put that to the sword, because you end up, although that may seem counterintuitive, with increasing sort of borrowing around those rate cuts, the real issue is the net interest margins of the banks start to contract, and so earnings actually start to shrink rather than just be stable. And at some point, someone's going to look at CBA on 24 times and
decide that maybe an Nvidia or something like that.
decide it should be on 12.
Not similar multiple might have more growth. Yeah.
That's right. I mean, CBA as in Nvidia, only in Australia. So then I think, as I've kind of argued this for the last, year or two, looking out into the next cycle, business cycle coming out of this easing, it just gets worse and worse for Australia, I think, as China slows and slows and commodity prices just keep falling, and for this I see kind of late 1990s analogy, where you had Japan, coming out of its enormous bust that just slowly, wound down into the 90s, into deflation and, falling demand for pretty much everything. And the economy just stagnating almost completely and getting left behind. And I think that's what happens to China over the next 10 years. And so, commodity prices just don't rebound. A little bit around whatever, but not like anything serious, unless you get a big war or something to disrupt supply. They just keep falling like they did in the 1990s, and you ended up with $12 iron ore, back then, or something like that. And so I think that's what's coming over the next kind of decade for Australia. And interestingly, the 1990s analogy holds up for the other side of the coin, which is kind of US exceptionalism, where you have these productivity enhancing technologies in the US that may be slow, medium, or fast in their rollout. At the moment, people are kind of considering it more likely to be slow than fast, but coming nonetheless. In AI, autonomous cars, and the weight loss drugs, and these things are combined pretty powerful forces, some of which will help Australia as well, it should be said, but not like the US, which does productivity-led growth so much better. And that's sort of comparable to the tech boom of the late 90s. And so you have a scenario in which you have a relatively strong US dollar with a very weak demand environment for commodities. And, I can see Australia really struggling in that environment, and especially the dollar falling and falling and falling. So
get your money offshore, international investments.
I think that's the play for the next, the next cycle, without putting a particular number on it. And if you're in your Aussie stocks right now, I mean, the run has been spectacular, especially if you're in the banks. And I'd just be cashing out and looking for greener pastures offshore before this China stuff really comes to bear.
Excellent. I think that's probably a good note to finish on. Thanks, Dave, for coming in and sharing with us today. Just a reminder, we're on every Thursday at 12:30. If you want to ask any questions, just throw them on into the chat. You can also catch us on a whole bunch of different platforms. You can get us on where are we? So we can get us on all the different major podcast platforms: Apple Podcasts, Spotify. We're on most of the social media. You can click through and grab our stuff. Sign up to our newsletter and get more things on a daily basis. On a weekly basis from what we're doing. And if you've got any more questions, certainly feel free to reach out and speak to us. With that, thanks for listening, and we will see everyone next week.